All right, let's compare some ETFs, people. First off, we got VOO. The ETF is down 17.31% so far year to date. This is the Vanguard 500 Index Fund ETF. It's a Vanguard ETF, so very well-known ETF, and we're going to compare this one also to VTI, which is down 18.36% so far year to date. So it's down a little bit more than VOO is, but this is the Vanguard Total Stock Market ETF, Total US Stock Market ETF, and then we're going to compare this one to a little bit less covered ETF. I don't see many YouTube videos on this one. We're going to compare these two to VT. And this is down 18.53% so far this year. So just a little bit more down than the VTI ETF. But the VT ETF is the Vanguard Total World Stock Index Fund ETF. So it invests all over the world, and it's a very interesting ETF to compare to these two. So let's go ahead, let's get started. We have VOO here, it's on the left side. We got VTI in the middle, we got VT on the right side. Let's start with expense ratios. So where are the expense ratios? They're all very cheap. So extremely cheap ETFs. We got a 0.03% expense ratio for VOO, VTI, 0.03% expense ratio. They have the same expense ratio, those two. And then we got VT a little bit higher, 0.07%. But again, very cheap ETF. So they're all very cheap. I want to talk about the dividend yield. We're going to go with VOO is a 1.64% yield. A little bit of yield, but honestly not a lot of yield. If you're a real dividend investor, you're going to want probably more yield than that, especially in this environment. VTI, 1.60%, same deal. This yield's probably not that high for you. But then we have VT. VT's got 2.44%. So VT's getting up there and maybe kind of like more exciting for people who are looking for yield. So let's talk portfolios. These are very broadly diversified ETFs, all of them. Now, the VOO ETF, it's not as diversified as the other ones, but VOO is still very diversified. So VOO has 500 stocks in it. So it says 506 here, but it tracks the S&P 500. S&P 500 is the top 500 largest companies in the US, 500 stocks. The other one, VTI, we have 4,031 stocks. So a giant ETF, tons of stocks, almost too many stocks, right? There's a lot of stocks in there. Difference between these two, the size of the companies. So VTI is going to also have not just large companies like VOO, it's going to have smaller companies. It's going to have some mid-sized companies. It's going to have some smaller cap companies in there too. So you're going to get a broader range. You're going to get you're going to get large, mid, you're going to get small in there. VT is different because, well, first off, it's got stupid amounts of stock in it. There's 9,608 different holdings in it. And in terms of the weighting of the different stocks, I do want to show you a graphic here. So the VT ETF, it tracks this benchmark index, okay? So the FTSE, FTSE, the FTSE Global All Cap Index. This is the name of this index that is used to track by this Vanguard ETF. The first thing I want to show you is what's in it in terms of sizes of companies, right? So like we said, VOO, it's only large cap companies. Now, this has large cap, mid cap, and small cap companies, okay? So more broadly diversified in terms of the sizes of the companies. So it's not just larger companies. So more similar to VTI in that aspect. And then of course, we also have on this side, developed, advanced emerging, and secondary emerging markets, okay? So that's what we're getting in this. We're getting developed markets, so we're getting stocks that are inside developed countries, which I'm going to show you in a second the differences. Advanced emerging, secondary emerging, and let's go ahead, let's show you the difference here. This is what FTSE is showing us, the different categories that they have for the different types of markets. So we have developed market, we have Australia, we have Austria, we have Belgium. See, these are developed markets. You're getting North America, you're getting Europe, you're getting Australia, you're getting New Zealand, and you're getting Japan. So these are the more developed markets throughout the world, okay? Then you're going to get some emerging markets. So emerging markets going to be Brazil, Czech Republic, Hungary. And then we're going to have some of the secondary emerging. So then we have Chile, China. We got the Philippines on here, right? Represent. And then next we have frontier. And so frontier is not actually going to be represented in this particular ETF. So frontier is going to be Bahrain, Bangladesh, Botswana, Bulgaria. So these are the different markets that you're going to have exposure to in this. So really you're basically going to be choosing, okay? You can get it all in one ETF if you want to. That's a way to do this if that's what you're interested in. Or you could go with something that's just domestic US, and we're going to talk about all this. Here we go. This is the juicy stuff, okay? We got the returns of these ETFs. Portfolio returns going back until the inception date of the youngest fund, okay? So we're going back until December 31st of 2010, and we're seeing how these ETFs have performed, okay? So if you invested $100,000, what would you have today? So final balance for VOO is $386,540. Final balance for the total stock market ETF, $371,153. Okay, so you have more money if you had invested inside the ETF, the Vanguard 500 ETF VOO, and if you invested in VT, you have only $228,913. So you definitely didn't do as good by investing in VT. And the compound annual growth rates here, so the how much was your return annually over time? So 12.1%, 11.72%, and only 7.25%. And then if we talk about standard deviation, which is going to be the risk that's going on here. So we're talking about, let's say, how much volatility there is inside these different ETFs, okay? So they're very similar, actually. And what I actually don't love is that we're getting the highest or the second highest standard deviation inside VT, but the lowest return. So I don't like that at all. What's going to happen going forward? Well, let's talk about international stocks versus domestic stocks. When it comes to investing in international stocks versus US stocks, there's really just times where international stocks really underperform US stocks and vice versa. And it can be years of time where this happens, okay? So we kind of have these like almost like secular longer term types of trends, right? 80s into 90s, huge gains for international stocks. This is the time period when Japan was booming, right? So there's huge money being made that was going on in international stocks at these times. And then there was the whole 90s was all about domestic US stocks. And then we had, dot-com bubble, Great Recession. We have a time period where international stocks start doing much better than the US, and then it flips. And it's been a very long period where the US has outperformed, let's say, general emerging market and even developed market stock markets, okay? So where are we now? I tend to think, honestly, if you're asking me what it's going to be like over the next few years, I tend to honestly think that the US stock market is going to do better over the next few years. The dollar is basically destroying currencies all over the world because the dollar, for example, in the Philippines, Philippine peso is down a ton versus the US dollar. Euros down versus the dollar. Pound down versus the dollar. Everything's down versus the dollar because of the Fed, right? So as long as the Fed's raising interest rates and interest rates are kind of high, we're talking probably about, honestly, a US economy that's going to probably do better and US markets doing better. But just make sure you remember, this is an opinion of mine. I honestly, I have no idea if it's going to happen or not. That's just how I feel. I do want to next talk about the regional exposures because this is going to be kind of the area that helps me decide which one of these I would want to go with personally. So, for example, VOO, obviously, it's basically all North America, okay? VTI, same. Basically, it should be all North America, right? And essentially, it's all domestic US stocks, okay? Then VT, we have what type of mix-up is the question. So 64% of the allocation here is going to be in North America, all right? So 64%, you have to ask yourself the question, do you want 64% of your allocation to be inside the US and the remainder to be in other parts of the country? Or do you want it to be a little bit mixed a bit differently, right? Do you want more money in the US, less in the international markets and things like that, okay? That's up to you. I personally would not want more than about 15% of my portfolio internationally. In fact, I really don't have much of any international exposure right now because, like I said before, I don't think international stocks are going to be performing much better than US stocks over the next few years. So I'll tactically, hop into international stocks at some point, but right now is not the time that I want to be doing that. And you're probably not that type of investor. You're probably long-term buy and hold type of investor. Just like let it flow into the ETF for a long time. So that's the question. Do you want 64%, or would you rather just have, let's say, two different ETFs? You could say I want VTI, or you could say I want VOO, one of the two. And I'll point you in the direction of my video about VOO versus VTI if you want to really see the difference between those two. Pick one of those two, and then you can go something with, for example, it's called VXUS. I'm going to throw it on here. So VXUS is a Vanguard ETF, but it's everything outside the US. So it's like VXUS or XUS stocks. So if you can see here, you can see that VXUS actually has everything outside of North America, but the North America part's gonna probably obviously be Canada. So everything outside the US. So you could go ahead and do this, and you could say, I want 15% of my portfolio in VXUS. I want 20% of my portfolio in VXUS. I want the other 80% in VTI or VOO or whatever it is. You could do that. Or you could literally just say, I just want VT because I want international exposure. I want a very giant broad diversification. I'm okay with 64% being inside of the US and the rest being outside. And if you're okay with that, then VT might be a great giant diversified ETF to throw money into, and maybe it's your only ETF, right? If that's the type of investor you are. So that's all I have for this. Take a look at my affiliate links below if you want to support the channel. Hit the like button, subscribe, disclaimer here, and see you in the next video.